Hello friends, today I am discussing with you how to construct a portfolio for higher dividend yield or higher dividend income. When we invest in the stock market, our priority is that we must have capital appreciation. There are two sources of income. One is capital appreciation and the second is dividend income. So let's say if you invest 100 rupees and the company gives a dividend of 1 rupee in a year, then dividend yield becomes 1 upon 100 into 100, that is 1%. That is the definition of dividend yield. So this means even though you are holding the stock, dividend comes to your pocket. So there are investors who want to make money from dividend and also make some money from growth actually. For them, it becomes very important to construct portfolio in such a way that maybe some part of the portfolio is growth stock and other part is dividend stocks. So today I'll tell you how to go about and select a dividend stock, and then you can choose the sets of stock as per your own liking, as per your own requirement, and then decide which stock to keep and how much to keep actually. So before I proceed, I would like to share with you that investment in stock is risky. So therefore, before investing, please do consult your investment advisor or do your own research. Purpose of this video is purely educational and for demonstration purpose only. So here I have opened a screen actually. If you just click here on screens, you will get all the standard screens which they have. Well, you can build your own screen also on different condition, but you can try yourself. Now here what I am going to look at is the dividend yield stocks screener. So if you go to valuation, you see highest dividend yield shares. So if you click on this, you will get a set of shares which are the highest dividend yield. Now, which one to choose from this, you need to do some research. So I have picked up 4 and constructed portfolio in such a way that it has got a mix of dividend as well as good potential, because you should not lose the capital as a capital loss. That is very, very important. That you have to see, you will see in from the chart. Like let's say Vedanta I have chosen. I have taken NMDC, I have taken Oil India, and I have taken ITC, which will appear below here. So I'll go with each one of them and tell you how this is going to help out. So let's look at Vedanta first. So when you look at Vedanta is a private limited company. You know, the market cap as of today is 1,08,000 crores and current price is 291. Sometime back it was 288, 287. So, and dividend is 17.5%. So very high paying dividend company. This means if somebody chooses this stock or bought this stock at the lower price, he is getting a huge dividend without doing much actually. ROC is 32% and ROE is 30%, which is fantastic. This company is engaged in oil exploration, mining, extraction, processing, and also does, production of zinc, lead, silver, copper, aluminum, etc., etc. So it's a metal company, also oil extraction company. And promoter holding here is about 70%, which is very good. So, and sales growth for last 5 years is 13% and profit growth for last 5 years is 29%. Fantastic. So now the question comes, let's look at the price for this particular company for 10 years. Now see, this type of company will have a cyclical sort of price pattern. So if you are able to pick up somewhere near here or here, your dividend yield will be much higher actually. So here when you look at on 1st of April 20, the price was 63 bucks, 63 rupees. And after that, the company had given almost a dividend of 100 plus rupees per share. This means if somebody bought here, today whatever he is getting, share he holds free and he is getting more than the dividend. So this type of stock, you have to be very careful. You should never buy when it is peaking here. You can try buying when it comes closer to 200 days moving average. Like here, again, it was 200 DMA. But before that, if there is a bull run, forget this. So when this price is going down, this could be a good, this one again price is going down, this could be a reasonable buy, I would call it. So now that gives you idea about buying, and then you can also look at P ratio and find out if the stock is cheaper or at this price or costlier. So if it is lower than the 5 years median, then you can call the stock to be cheaper. So 5 year median is 8 and actually it is trading at about 6. From that perspective, Vedanta could be a good buy. And that's the reason I have included Vedanta in the portfolio. Let's look at the other stock. Let's say NMDC. Now NMDC also, you see here again, dividend yield is 11.2%, ROE is 30%, 37%, fantastic numbers. Profit growth, sales growth is 24% for last 5 years. Profit growth is 29.4% for last 5 years. Promoter, which is Government of India, holding 69% shares. Now when you look at the price of the share, you will find a very similar pattern. See, somebody who bought here for dividend, he has lost a lot. But here afterwards, this is just fluctuating. And this is like a monopoly in mining sector. So here if you do a good job in terms of picking the stock, you will make a good money. Like, when the price is lower than, substantially lower, like sometime back, about just on 15 July 22, it was 100 rupees. So that could have been a very good buy, or anything from less than 120 was a good buy. Now it is a little more, but let's look at the relative strength. Look at here, the median P is 7.7, whereas this is available at about 6P, 5P. So even still at this price is a good buy, but you can look for some sort of fluctuation, some sort of falling down by a few bucks. Let's say 130. If you are able to get it about 120, it could be a very good buy, and one should certainly hold this stock in the portfolio. So these are the top 2 stocks. Then I am talking about All India. Now let's look at All India. Again here, dividend yield is 7.65% and ROC is 20%. Normally, ROE of more than 20% is supposed to be a good return on equity. And sales growth is also 20% plus for both 5 years time frame, and profit growth is around 8%, 18% plus. So good numbers. And now again, if you look at the stocks, you will see a fluctuating thing. This is not continuously growing as we had discussed earlier. So here you will see the fluctuating stuff. So again, art depends on how do you pick it up. So here it could have been fantastic, but since there is a growth, we need to sometime track it when it comes to allowed, let's say 170, the price is closer to today is 187. If it falls few more rupees, good. Otherwise at this price also, let's see the attractiveness. Quite attractive as per the earning, and the median P for last 10 years or last 5 years median P. Median P is 6, and this is available at about 3 PE. So good at this price. So this is the way to add stock in your dividend yield portfolio. And the last one, we talked about ITC. ITC of late has been giving a very good run for profit growth, and it is a very good stock. It has a dividend yield around 3.7%. I think I am just missing somewhere. It must be a part of this list actually, because normally maybe this list is more than 4%. ITC yield is 3.74%. So you can customize this list as per your own requirement also. So why I have chosen ITC? Because it's a very defensive stock. So now this set of 4 stocks are a good weight for your portfolio, and they are not only dividend yield, but they also give us some sort of defensiveness in your portfolio. So when the price is falling, these stocks will not fall too much. When the price is rising, again the stock will not rise too much. So I think it will be a cushion to your portfolio, and also will be a good income in your pocket. So friends, just to summarize, these 4 stocks which I discussed, if you look at these 4 stocks, this is the summary. Like Vedanta, about 291 today, 17.5%, ITC 336, 3.4% dividend yield, NMDC 131, 11.3%, and WAL 185, 7.73%. If somebody has 15 lakhs of corpus and distributes equally, well, you can vary even this as well. Then these are the dividend income which you will receive in a year, amounting to around 1,50,000 rupees per annum, about let's say 12,500 rupees per month, and 10% annual rate of return. And somebody wants to get an income of 1 lakh dividend per month, he has to invest around 1.21 crores. Or if you choose at the right price or right time, this money could be quite less. So friends, I have explained you how to go about choosing dividend stock, and depending on your risk appetite, you can do a further research. But don't go for, like, let's say Vedanta is giving 17%, don't put all money in Vedanta, you need to diversify. So you have to have a mix. from the different type of company, different type of management, and then you can construct your portfolio. Don't buy all stocks from public sector. Don't buy all stock from private sector. So do some sort of juggling, and then you will be able to really make your portfolio rich with dividend stock, and you will earn a good income per year. One thing I like to tell you, when I say per month, that is just conceptual, because this money is not going to come to you every month. Normally, this dividend is declared by the company. They do declare interim dividend as well as final dividend. So as and when dividend is paid at different point in time in a year, you will receive this money. So that is the caveat. And if you like this video and not subscribe to my channel so far, please do it. Circulate this video amongst your friends, relatives, and ensure that they get benefit out of this deliberation. Feel free to put your comment and like the video so that we can bring more and more video to you of this type. Thank you so much for your time and stay engaged.